And I'm going to go ahead and kick off this conversation. And the reason I wanted to do this conversation is to share it with other people so that they get an idea of what they can do with their 401k or IRAs or whatever that they have, and take that out of something that they don't feel is performing as well and put it into something else, and they can manage that asset. So I did this with you, gosh, I think 3 years ago. And mine's a success story because I worked for Hewlett Packard for many years, had a pretty big 401k, transferred it over into an IRA. And for the last 20 years, it stayed stagnant. And I finally took it out, invested in some real estate, and I've seen that real estate within 3 years. Of course, it was a hot couple of years, but within those 3 years, I've seen about a 40% increase. And then in addition to that, the properties and the rental income, because I paid cash for those properties, has been significant to the tune of about $6,800 a month. Nice. So not only have I seen about a 30 to 40% increase on those properties, I am also getting an income that is going back into the kitty of almost $7,000.
That's great.
So with that being said, for me, it was very, very beneficial and valuable. And I just love the idea of being able to do that. I think 401ks are really something that was set up by the government anyway. And unless you're getting matching, it doesn't really make sense to keep them there, right? So that's my success story. So I'm intimately familiar with how this works and I love it. So I wanted you to share this with other people, and I'm going to go on mute because I'm at a Starbucks. It's Red Day with Keller Williams, where we go out and volunteer all day. So there's a lot of background noise, and I'm going to let Brian just kind of run the show and do a quick overview of what a self-directed IRA is.
Perfect. Well, thanks for the introduction, Danielle, and thanks for having me here today. You're right, self-directed IRA and oh, shoot. Danielle, you disabled my participant sharing. There we go. Well, you're just going to share your version then. Okay, that's fine. We'll just go through with Danielle driving the slideshow then. But yeah, I mean, as Danielle said, self-directed IRAs are a real exciting topic. I'm happy to share some information with some folks. I'll kind of give a real quick overview of the lay of the land and get us to where we can have some question and answer. But the bottom line is you can take the tax sheltered money that's so valuably created in 401k and IRA programs and just have more choices about how to put that work instead of letting it languish in some little stack of mediocre mutual funds that come with most 401ks. You can invest in things like real estate and stock of privately held companies and things of that nature. So there's just a lot of opportunity to go get better results for that money. And yeah, as Danielle said, 401ks are created by the government as a means to set money aside and give it tax sheltered status. And that's great. The input side of a 401k allows you to get a lot of money in. But sometimes the investment choices are limited. So by changing up the investment choices, you can really do some powerful wealth building with these types of tools. Let's go ahead and go to the next slide. So I'm with a company called Safeguard Advisors. We specialize in what are called self-directed IRA and 401k plans. We've been doing this since 2005, working with clients all across the country. We're basically a small consulting firm that just specializes in educating people about these topics and what can and can't be done. Of course, we've built a lot of expertise in both real estate and in tax law, so we can help people navigate what they're doing as they evaluate and use these programs. Go ahead and move forward. So what is a self-directed IRA is obviously a good starting point, and basically it's just a regular IRA, but with more investment choices. Self-directed really is a very broad term. It means somebody is managing their own money as opposed to giving it to a money manager. Well, you can have a self-directed IRA at E-Trade or Vanguard and pick your own stocks. A truly self-directed IRA or 401k is what's going to expand your investment choices, get you beyond the the limits of the public exchanges and into non-traded assets like real estate. A lot of the common things that we'll see people invest in are, direct real estate like a rental property, real estate partnerships like syndications, doing private lending for new construction or for other investors, things of that nature. And those are all ways that you can potentially better protect and grow your tax sheltered savings. Let's go ahead and move forward. So what would make you want a self-directed IRA is basically control. You can invest in things that you know and understand, where you can have more control over the outcomes, potentially identifying a situation to acquire an asset at less than market price, seeing ways to potentially add value through improvements or just restructuring the finances of a deal that maybe wasn't set up originally the right way. But just, basically you get to choose how the money's invested. You get to choose the deals. And that just gives you a lot more control over the outcomes. Go ahead and move forward. Of course, one of the other, initial questions to ask is, is this for me? And it really boils down to two things on the qualification side. Firstly, you got to have some gas in the tank. You got to have some funds that you can move from a previous retirement plan. There's a lot of different plans you can move from. Any kind of IRA, traditional Roth, simples, SEPs, they can all be moved, even including inherited IRAs. There's going to be limitations on what you may or may not be able to combine from different plans with different tax types. But any IRA is going to be portable. A 401k or similar plan, like a profit sharing plan or pension from a previous employer, is going to be able to be moved. And a plan with your current employer can potentially be moved if you're over normal retirement age of 59 and a half. One of our limitations, we'll see somebody, I've got my 401k with my current company. I wish I could invest it in better things. That's probably going to be locked up where it sits. It's usually a little difficult to get money out of a plan unless you've left the employer. And then the other side is, you got to have enough gas in the tank to get down the highway. You're not going to buy real estate with $20,000 in your IRA. There's no real hard and fast rule as to how much money you need to have, but it needs to fit the types of deals you're wanting to do. A lot less with some private lending than if you wanted to buy a rental house in California, for example, or maybe you want to buy a rental house in, Missouri. Well, that's going to be a lot less than in the Bay Area. So you just got to look at what you have and say, can I, within this envelope of funds, achieve the goal? Because as we'll see a little later, you can't really mix and match this money with other forms of personal money. Let's go ahead and go forward. The plans that we deliver here at Safeguard focus on providing our investors with what we call checkbook control. And that's a real important way to approach this type of investing. There's some other types of self-directed IRAs where you have a third-party institution that holds the funds and signs every document and cuts every check and sort of acts as your processor. I'd like to say E-Trade, but instead of computers doing stock trades, it's people pushing paper. It doesn't work real well with real estate. You need to be more nimble. You need to reduce the transaction costs, and they're going to add up in an environment like that. So we focus on putting the checkbook in your hands and giving you complete authority to act as you need. And I'll talk about how we build that in a moment. But everything we do stays very much within the framework of the tax sheltered environment of the IRA. Let's go ahead. So there's two types of plans that can get you that checkbook control. There's an IRA. Pretty much anybody can go that direction. We call it a checkbook IRA. That's a pretty common term used in the industry. Can invest in anything the IRS rules allow for. Can accept money from a lot of different sources, and it can be, a regular tax deferred IRA. It could be a Roth IRA. A lot of different ways you can build and fund that. That's a very accessible route to taking this type of approach of self-directing your plan. We also, on a more limited basis, offer what's called a checkbook solo 401k. And while on the investment side, it's very similar, the flexibility, the investment choices, the checkbook control, it's a different type of retirement plan on the back end. It's an employer-sponsored plan that's designed for somebody who qualifies by, in some fashion, being both self-employed and also not having any full-time employees in any business they control. And the real benefits are on the plan side. It's got higher contribution limits. You can have a combination of both tax deferred and Roth money in the plan, and more flexibly do in plan Roth conversions. There's a loan feature where you can borrow a little money from the plan. 401ks have that and IRAs don't. And I'll talk about this a little later in the conversation. But if you're planning on making investments that require debt financing, like a mortgage, 401k is going to have some advantages for you there. So a couple different ways we go, and we always start our conversations with any potential client at looking at what's going to be the best fit for your needs. Do a quick rundown of the couple programs. Again, just keeping it high level here. But with the checkbook IRA, it's this two-layered structure that we create that gets you the flexibility that you're looking for. We start with a company called Solera National Bank acting as the IRA custodian. They're the record keeper and reporting layer, just like a Schwab, Fidelity, Vanguard, anybody like that. Different paperwork, different processes to facilitate non-traded assets. So that's why we use them as the custodian. We're going to have that IRA make one investment into a specialized legal entity that we create. And if you're in California, we're going to use a trust. LLCs in California get kind of complicated and expensive, but basically a legal entity. And the idea is that the IRA is the owner, say the grantor in the case of a trust. You can be the trustee, the person who has signing authority and the ability to conduct the affairs of that. So in a way, it's kind of like having a more conventional IRA invest in a single fund, but you get to be the fund manager and determine how that fund's capital is going to be deployed. So that's the concept that we're creating there. Go ahead. The solo 401k is a little different architecture, but the same end result of, you got a bank account with signing authority. You do have to have some kind of qualifying self-employment. You could be a sole proprietor, have a corporation or an LLC, but you just have to have some for-profit business activity that qualifies to set up an employee benefit program. And it also has to have no full-time employees under that or any other business you have. Once you have employees, you can't be in the solo 401k. You've got to be in a more conventional, what's called an ERISA 401k. And those are very complex. You wouldn't want to self-direct in one of those. But the solo 401k is great for self-directing. The plan itself is a trust, and you get to be the trustee. So we eliminate that layer of a custodian. You can just basically self-administer the 401k plan. And again, as I said, some of the benefits are on the plan side itself, really high contribution limits. You can put as much as 67,000 in, and I think that's actually last year's number. I probably need to update that. I think that's now the number if you're under age 50. If you're over age 50, it goes up to 73.5. Again, both tax deferred and Roth features in the plan, and it's exempted from some taxation that an IRA would see in the event of a leveraged investments. So similar but different. Really, the differences are in the architecture. Go ahead. So you got this tool. You got more choices over how you can invest. The key thing to keep in mind is it's still tax sheltered money. And in order to keep that tax sheltered status, the IRS gives us some rules we need to follow. And they're basically, everything has to be kept inside this piggy bank, this savings account that's really set up for your future self when you reach retirement age. And prior to that time, or even at any time that you have money in the plan where it's tax sheltered, everything just has to be done at arm's length and exclusively for the benefit of the plan. You can't be creating a personal benefit today, right? If you do that, you violate the rules and you end up with some really pretty severe tax penalties. And really what it boils down to is the IRS defines what are called disqualified persons, and you just need to avoid them in all ways, shapes, and forms. And those disqualified persons are yourself, your spouse if you're married, lineal family like parents, grandparents, children, grandchildren, the spouse of a descendant, or an entity like a business or trust are going to be the key things that one of those people own are going to be the key things to avoid. There can be some financial entanglements like a fiduciary to your plan or a co-owner of some business you might own would also be viewed as disqualified. You wouldn't want to have any transactions where the plan's buying from, selling to, hiring that person to provide services, things along those lines. So, you can't go out and your plan can invest in a vacation home. It can't be a vacation home that you ever vacation at. It would just be a rental to other vacationers. Let's go ahead and move forward. So now I want to just sort of touch briefly on some of the more common investments that people choose to pursue. And I'm sort of focusing on real estate because that's our focus with this audience here today. There's of course some other things. But one of the more simple approaches that works well for people who are very busy or maybe have a little bit less capital to work with is private lending. Your plan can, in effect, be the bank and lend money to really anybody who's not a disqualified person, to a real estate developer for new construction, to a business person who's starting a business and wanting to acquire some equipment, to an investor who's just wanting to pull capital out of a property and turn it into their next deal, whatever. But basically, your um, plan can hold a note and fund that note and then receive the principal and interest payments. And of course, that'll all go tax deferred back into the plan. It's just a nice way to decorrelate from the stock market and get some money to work in something that's pretty stable and predictable. Let's go ahead. One of the other more real popular options is rental property. The nice thing there is you're almost in a way creating your own annuity with real estate, right? Your planned capital is placed into a very secure real asset with the potential for both cash flow and appreciation. That's where you beat the annuity. Annuities don't appreciate; they just give you predictable cash flow. The plan entity, the IRA LLC or trust or 401k trust is going to be the party to the transaction. So it'll be on title, all expenses for the acquisition or maintenance of the property, property taxes, insurance, things like that are paid by the plan out of the checking account. And then any of the income, of course, goes back into the plan account, and that stays under the tax sheltered umbrella of the plan. You can, in a limited sense, manage your own properties. There's certain things you can and can't do. You can't go work on a property or pay yourself a management fee, but administratively, signing a lease, collecting the rents, calling out a handy person to do some repairs and paying for them for their work, that kind of stuff you can do. But you can't put in any sweat equity. You can't gift services to the plan. That'd be kind of like making an undocumented contribution. And then, your plan can go out and buy a property on its own. It can also jointly invest into partnerships or working with, maybe just one or two partners. You can also use mortgage financing. I'll speak about that a little later in the show. So it's not like you have to have, 100% of the purchase price of a property in order to do this kind of investing. Go ahead. Just mentioned mortgage financing. That is something that can be done and basically extend the reach of your capital. There's two main things to keep in mind when considering this concept. Firstly is that debt instrument, that mortgage has to be what's called non-recourse. And that means there's no personal guarantee from you. Basically, it's an asset-based loan where the plan is qualifying for the property. I'm sorry, not the plan, but the property is qualifying for the loan. There's a handful of lenders that do that nationally, about 4 or 5. Solera, who works as our custodian on the IRA side and is a great bank to bank within the 401k, does happen to be one of those lenders. So they're a good first place to take a look if you're interested in this. But it's a more conservative loan, right? The bank's lending based on the property solely, not on your income and your personal resources. Again, you can't put a personal guarantee on your IRA's debt. That'd be violating those IRS rules. But you're typically going to see, loans where there's a higher down payment, maybe 30 to 40% down, about 10 to 15% of the loan balance held back in reserves because if there's no tenant in there paying rent, the IRA or 401k still has to pay the mortgage, still has to pay the property taxes and things like that. So the lender's going to enforce you to take a pretty conservative approach there. And then, as I mentioned, in an IRA, there can be taxation on the use of the borrowed money. I'll come talk about that in the next slide. But the bottom line result either way is that the use of leverage boosts your return. It's a key foundational principle of investing, and it's true here. And you're not using leverage in your Schwab account trading stocks. So really opens up a lot of possibility with these self-directed plans to bring that power into your investing. Let's go ahead. So wanted to give you a little idea on that taxation here. And again, this would apply to an IRA, but not to a 401k if you qualify for that. The 401k has an exemption on this tax when the debt has to do with the acquisition of real estate. But the idea here is that you've got an investment where the IRA has placed some of the capital into the deal, but some of the capital that funds the purchase is coming from non-IRA money, the borrowed money that's being brought to the table. And it's that portion of the income that that's attributed to the non-IRA money that's deemed taxable. It's called unrelated debt financed income, or UDFI. So you take a little example here, and I'll just fly through this because we're trying to be conceptual here. But say you had a $150,000 property. You put what did I come up with there? 55,000 down and borrowed 95 from a bank, and maybe it's making 21,000 a year in gross income is what you got. Well, when you look at that property is 64% debt finance. 64% of the capital that went into the purchase came from the non-IRA money. So that means 64% of the income is the UDFI that's taxable. And in this example, that'd be just over $13,000. Well, if you did this deal all cash, you wouldn't have any taxable income. So therefore, you wouldn't have any place to take advantage of your normal deductions. Once you introduce taxation, now you get to take advantage of deductions. And that's where this wins, because you'll take in that same ratio all the normal deductions for depreciation, interest on the note, allowable operating expenses like property taxes and insurance, things like that. And that's going to allow you to, in this example, just sort of running up with some mock numbers, pull almost 11,000 that income off the table. And so that really reduces the tax impact. There's also just a $1,000 exemption against UDFI straight off the top. So in this case, even though we made $21,000 of gross income on a 64% finance deal, we only had $1,600 of net taxable income after doing all the calculations. And when you run that through the trust tax table that the IRA is going to pay taxes on, your net tax amount is $240. And if you didn't make more than $240 a year through the principles of leverage, you bought a bad house. So it's a real win. A lot of people get intimidated by that concept, but when you run the numbers and see what the tax impact is, it's really pretty trivial. It's just the bigger challenge is just knowing this exists and not running blind, and not failing to file a tax return when you have one due, and then finding a resource to help you with the tax filings. You just want to line that up early, not be looking for that in March as April 15th is approaching. But it can be a real powerful way to accelerate the growth of your IRA. Let's go ahead. Another way to look at investing, if you're a busy professional, you like the idea of real estate, but maybe you don't live in a market where you've got the budget to acquire a rental property, or maybe you just you don't think you'd be the best landlord in the world. You'd rather let professionals do that. Joining as a limited partner in a real estate syndication can be a real nice way to tap into this asset class that's a lot more hands-off. It's basically like buying a rental house, except for instead of owning 100% of one door with your $200,000, you can own 2% of 100 doors, and let somebody else manage the deal. Otherwise, it looks pretty much the same. The debt financing would apply if it's present, which it usually is in those deals. But it's just a way to get into a more robust, higher performing asset class and let somebody else do the asset managing. So that's been one of the more popular ways to put money to work in the last 5-6 years. That was really opened up as an avenue to common investors with some tax laws that were passed in 2012. Of the Jobs Act. It used to be you had to be a really high net worth person to even be able to look at this stuff, and that's been made more broadly available and become really popular as a result. Let's go ahead. Same thing in syndication. You're going to have a UDFI implication. Here's an example of what that looks like. And again, you can see, you put $100,000 to work and you get a $300 tax bill at the end of the year. You should have made probably, $9,500 of deposits to your plan on that investment. So pretty small impact of the taxation, but again, just something to know that it exists and be aware of. But generally, that leveraged deal is going to perform better than some non-leveraged alternative is the end result. That's what you want to look at. Let's go ahead. Another thing you can look at in a limited way is using IRA or 401k capital to fund developing new properties or flipping properties. Those are both places where there's an opportunity to, potentially buy at a discount, add value, either through building something or rebuilding something, as the case may be. There can be some, potential for some pretty high margins when you do that. So it's definitely a popular approach. There's the two limitations that come into play in a retirement plan here. One is, again, you have to be arm's length. You can be a fund manager, but you can't be a contractor. You can't go pull licenses in your own name, permits in your own name. You can't, go swing hammers. You shouldn't even be the delivery person going to Home Depot every day and getting your contractors what they need. You basically need to be somebody who's making decisions and writing checks and hiring the right people to do the work. So that works for some people. It doesn't for others. A lot of people will partner with somebody who's more actively managing a deal, for example, and go in jointly on a flip transaction as a way to make sure that they're keeping on the right side of the rules there.
Brian, I just
Yeah.
conscious of time. I've got the free version of Zoom, so that means we probably have about 3 minutes left because we started late.
Oh, okay.
I think
then we should probably go ahead and wrap it up. Let's just flip through the next couple slides just to make sure there isn't anything big I missed. Nope, go ahead. Go ahead. Yeah, one more. Yeah, we're done. So real quick, just when you're flipping, that's considered a business. And when a tax exempt, like an IRA or 401k, engages in a business on a regular or repeated basis, it becomes subject to some taxation where you don't see as many write-offs as you do on the tax on leverage. So that can be a real drag on your performance. So you just want to limit the amount of that you engage in, rather than just say, I'm going to focus on doing that one thing. That won't work well in a plan. Well, good. We'll wrap it up there. Do we have any questions? Let's go ahead and use the chat for that.
I don't see any questions. But one of the other things I'd like to just bring up is the solo IRA is super important for people to consider if they're in real estate. So the real estate agents that are also going to be looking and listening at this presentation, that's something to really factor in if you have a good year, right? What did you say if you're over 50? It was 7350.
I think it's 73,500 if you're over age 50, 67 if you're under. I got to go double check those numbers. They change them on me every year, and my memory is getting better and better as I get older and older. But yeah, and then just to get Charlie's question here answered, just in case we get cut off. Yeah, any expenses associated with the operation of an investment are going to be paid by the plan. Your 401k is not exempt from property taxes, for example. So those would just be an operating expense like repairs or insurance or anything else. But yeah, everything, all expenses are paid by the plan. All income flows back to the self-enclosed world. Yeah, I mean, going back to Danielle's point, we have a ton of clients who are real estate agents or active real estate investors. They're contractors or whatever, but they're already in the real estate world. They know and understand the asset class. They have some kind of qualifying self-employment, and the 401k is a great fit for those people.
So thank you so much, Brian. I really appreciate this. We're going to have to do this again where we get our links a little bit better organized, because I think we had 2 links out there, and I think some people were trying to get into another one. But I'm glad we have this recorded, and your contact information is also on the screen, right?
Yep, it's all there.
And then also, if anyone has any questions or wants to ask me about it, feel free to reach out. But for all of the real estate agents out there that are going to listen to this, it's a really great tool to have in your back pocket when you're talking with potential investors. A lot of people are super frustrated with the stock market right now, and where their assets are heading and what they're not doing. So it's a great tool to have in your back pocket to get more business. So with that being said, we're going to wrap up. I really appreciate you, Brian. And thank you everyone for coming.
All right. Thank you, Danielle. Have a great rest of your day.